I'm Tim Miller, and today's topic is bonds are inversely related to interest rates. Let's start with bond basics. Traditionally, if you look at a AAA corporate debt, there's very little risk. A AAA-rated corporation going out to the market to raise $1 billion via debt gets the very best interest rates of all corporations. In today's environment, maybe that interest rate is 4%. If interest rates fall after that bond is issued, it helps the bond price. Let me give you an example of this. If the current rate is 4% and the future rate drops to 3%, then someone who is going out on the street to get a AAA bond would get a 3% coupon rate. If they had a choice of buying a new bond paying 3% or buying your bond at 4%, which would they value more? An investor would pay a premium to purchase your bond because it's paying a higher coupon. Therefore, a bond that originally traded for $10,000 might now be selling for $11,000. The value of the bond has increased because interest rates have fallen. The opposite is also true. If interest rates rise, the going rate for a new bond might be 5%. If the new debt is yielding 5%, but you have a bond that's locked up at 4%, then everyone would prefer the new bond. In this example, the prices fall. Your bond that originally traded at $10,000 might now go for $9,000. Of course, you aren't required to sell at that discount. In most cases, you would simply hold that bond until maturity when it would return par value. If we understand how interest rates and bond prices are related, we know exactly what fixed income we need to own for the environment we're in. Although we don't know the timing, the Fed has made clear their intention is to lower rates. With the prime rate over 5% and a Fed target of 2.5%, we know that rates have to go down. If we're in the stage of the business cycle where the Fed is lowering rates, the economy is already cooling off. We don't want exposure to higher credit risk by owning junk bonds. Junk is typically held in a rising interest rate environment. As rates drop, we want to own AAA-rated debt. That's the debt that benefits the most from the falling interest rates. Therefore, the type of debt we do not want to own in a falling interest rate environment is high yield or junk bonds. Junk bonds and regular corporate bonds are similar in structure. Both promise to pay interest and return the principal at maturity. However, junk bonds differ due to their issuer's poor credit quality. A higher yield is necessary to compensate investors for the added risk. In some cases, companies may issue junk bonds when they need to raise capital despite financial challenges. It is more typical that an A-rated company gets downgraded to B, which means they need to increase their effective yield. Here's an example. For an A rating, a company issues bonds at 5%. That company gets downgraded to B rating, meaning they should be offering an effective yield of 7%. This happens through something called arbitrage. If a bond you bought for $10,000 at 5% for 10 years, the price of that bond will need to drop to $7,140 at a B rating to attract investors for an effective yield of 7%. As the rating of the bond rises, the price of the bond rises. Look back at 2022 and 2023, when we were in a rising interest rate environment, junk was the place to be. The chance that corporate debt would default was very low. And companies that had lower investment grade debt, B or double B, also benefited from the economy. As a company upgrades their rating, their pricing will adjust accordingly. As the economy gained momentum, we witnessed a lifting of corporate valuations. We saw examples of bonds going from $5,700 to $6,600, which is roughly 16% return. It may seem counterintuitive, but any environment where the economy is doing well and interest rates are rising, high-yield bonds or junk bonds are the safest place to be. At Advice One, we want you to understand the relationship between interest rates and bond prices so you can make informed decisions about your fixed income portfolio. Remember, it's not just about owning bonds. It's about owning the right kind of bonds for the economic environment we're in. Thank you for listening, and I hope you found this helpful.